So today we are going to continue with chapter 2, which looks at individual investor portfolios. Then after that, we're going to go on to chapter 3, which looks at managing institutional investor portfolios as well, right? So you will see that so far we have looked to see exactly how do we prepare the investment policy statement for an individual portfolio there, right? Remember, we have looked at the different concepts. The way we said, when you're looking at in preparation of the investment portfolio statement, we said that you need to be able to look at the return objectives. We also look at the risk objectives. Then we also look at the issue of the time horizon. We also look at the tax concerns. We also look at the liquidity concerns, and we also look at the legal and regulatory issues. Then we also look at what unique circumstances there, right? Then remember we said the risk and return are basically objectives. So these are objectives. And then the tax issues, the time horizon, the legal and regulatory issues, the liquidity issues, and the unique circumstances, these are constraints, right? So which means that these are the constraints that are basically hindering the investor from being able to achieve what? Their objectives as well, right? So which means that whenever you're preparing an investment policy statement, these are the issues that you need to make sure that you're able to address. So remember, in the previous class, we looked at the that family there, right? Where we're looking at the family where they were. It was a family of 5, where it was the husband and the wife and the 2 kids, and one of the kids had what? Had a child as well, right? So we looked at to see exactly how we prepared the investment policy statement for the Inga family there, right? Then from here, we now need to look to see exactly how do we also prepare an investment policy statement where we are looking at it from another individual. Then from this perspective, this is where we're now going to be looking at section 5, where we look at an introduction to asset allocation. But when you look at section 5, what you need to take note that is specifically for Inv4801 exam, the lecturer is not that much concerned with the with including asset allocation when it comes to preparation of the investment policy statement. So you will see that when it comes to the asset allocation portion there under this chapter, when we're going to leave it for now, because we're going to cover it in detail in chapter 5, where we look at asset allocation for a particular portfolio to see exactly how do you determine exactly what percentage of your portfolio is going to be invested in what? In a particular asset as well. So we're going to look at it in detail in chapter 5, because in most cases, the lecturer loves to ask questions regarding the mean variance frontier. So the lecturer loves to ask questions regarding the mean variance frontier. So we're going to be looking at it in detail in chapter 5, where we're going to look at in detail asset allocation as well, right? So please take note, when it comes to chapter 2, the main thing that you need to make sure that you take note from chapter 2 there is basically how do you prepare an investment policy statement for individual, whether it's a couple or it's one individual. We need to see exactly how do you prepare an investment policy statement for individuals, following these steps where you look at the objectives and the constraints. So today, we're also going to look at preparation of an investment policy statement for an individual to see exactly. So if you are to prepare an investment policy statement for a single individual, ideally, how would you go about to prepare the investment policy statement there? And this is covered under section 5 of chapter 2. Then after this, we are also going to be looking at chapter 3, which looks at managing institutional investor portfolio. Now, when it comes to chapter 3, please take note, I have never seen the lecturer asking questions to do with preparation of an investment policy statement for institutional investors. In most cases, if the questions come in regarding institutional investors, it's basically those questions that are basically knowing the mechanics of exactly how it works for institutional investments, whether it's a pension fund or it's a whether with a pension fund, whether it's defined contribution, or it's a defined benefit plan, or whether it's an endowment, or any other type of investments that we're going to be looking at there. Though the mechanics of how they work is basically what you need to know from chapter 3. The preparation of the investment policy statement, for the sake of the exam, I would not really encourage you to worry much about how you prepare the investment policy statement. So what we're going to do now for chapter 3 is that I'm going to guide you for you to know the general information that you need to be able to know for every step that you are going to be following when it comes to the preparation of the investment policy statement for institutional investors. But knowing how to prepare it in detail or looking at an example, I'm not really going to do it in detail, mainly because I've never seen the lecturer asking you questions regarding that. What the lecturer has asked you questions pertaining to is basically calculation-based questions where you are expected whether to do a particular calculation to see exactly whether the fund is sitting with it's underfunded or it's overfunded, and also whether when it's in the case of a pension plan, and also in the case where they would ask you to now know exactly what are the mechanics or the implications of certain changes that can be made to a particular institutional investors portfolio as well, to see exactly how would they be affected by what certain changes as well. But when it comes to the preparation of the investment policy statement itself, I've never seen the lecturer asking you to do that, but I'm going to guide you through the different steps so that you know generally that for each type of institutional investor that are going to be looking at there, what do you need to be on the lookout for when it comes to preparation of the investment policy statement. But remember, for chapter 3, don't spend a lot of your time looking at the preparation of the investment policy statement. Just know the mechanics of how these types of investments also works as well. So are there any questions before we proceed? Any questions? Remember now we're on chapter section 5 of chapter 2. We're now on section 5 of chapter 2. And on section 5 of chapter 2, we are looking at an introduction to asset allocation. But remember here, the main thing that we need to be able to look at is to see exactly how do we prepare the investment policy statement for an individual. Then later on in chapter 5, this is where we're going to be looking at in detail asset allocation, where you're going to be looking to see exactly how to determine the asset allocation for a particular investor's portfolio as well. So we're going to be looking at asset allocation in detail in chapter 5 of the textbook as well. So looking at this, they tell us that, so if you look at section 5, they say, in establishing a strategic asset allocation policy. So here they say, in establishing a strategic asset allocation policy, the advisor's challenge is to find a set of asset class weights that produce a portfolio consistent with the individual investor's return objective, risk tolerance, and constraints. So here they say, under asset allocation concepts, they say, this section illustrates how to arrive at an appropriate strategic asset allocation through a process of elimination. So example 2.1 introduces a new case study and provides the background information needed to establish asset allocation guidelines for a new private client, which is in this case Susan Fairfax. So can you quickly read through the information on the example 2.1 up to the last bullet point there? Can you just quickly go through the information up to the last bullet point, and then we'll go through the investment policy statement together. Please go through this information as well, this paragraph after the bullet points. Please go through this paragraph because it's got important information there as well. So please make sure that you go through this paragraph as well. From the given information, they are telling us that Susan Fairfax is 58 years old, and she's planning to retire at the age of 65. And as you can see, it also means that she's left with 7 years until she retires. Then her current salary is 500,000. She currently sitting with 2 million in savings, And she's also currently sitting with 10 million in what? Ownership of what? Reston stock as well, which is the employer. And she's taxed at 35%. Currently, the inflation rate is 4%. And as you can see, the annual after-tax real rate of return is what? 3% as well. So after-tax real rate of return is 3%. The inflation rate is 4%. Then she's taxed at 35% as well. So from this information, we can now be able to find out exactly so we now have the information that we need for us to be able to prepare the investment policy statement. So as you can see from the information that is given, they give us an overview of the investment policy statement, and here they say Ms. Fairfax is 58 years old and has 7 years until a planned retirement, which is at the age of 65. And here they say she has a fairly lavish lifestyle, but few financial worries. Her salary pays all her current expenses, and she has accumulated 2 million in cash equivalents for savings from savings in previous years. Her health is excellent, and her employer-paid health insurance coverage will continue after retirement. So she has sought professional advice to begin planning for a retirement investment future, a future that is complicated by ownership of 10 million block of company stock, which means that the reason why they say the future is complicated by 10 million block of company stock is mainly because her portfolio is not diversified. Majority of investment is in what? Her employer's company stock there. So it's another issue to take note of. Then they also go on to say the stock is listed on New York Stock Exchange, pays no dividends, and there's a zero cost basis for tax purposes. So all salary, investment income, and realized capital gains are taxed to Ms. Fairfax at 35% rate. The tax rate and 4% annual inflation rate are expected to continue into the future. So which means whenever they give you the question to prepare the investment policy statement for a particular individual, check to see exactly the information that they're giving you regarding the inflation rate, or regarding the inflation rate, and also the expected rates of returns as well. For which period are they relevant for? You need to make sure that you also check to see for which periods they are relevant for as well. Then they also say Ms. Fairfax would accept a 3% real after-tax return from the investment portfolio to be formed from her savings portfolio if that return could be obtained with only modest downside risk, which means that she's not prepared to lose more than 10% of her annually as well. And they say she describes herself as being conservative in all things, as we have seen in the last paragraph of information that we gathered there as well. So remember, now we're saying to prepare the investment policy statement, the first thing that we need to be able to address there is the objectives. And the objectives are return objectives and risk objectives as well. So when it comes to the return requirement for a portfolio, what do we see? Remember, we are told that a real rate of interest that she's comfortable with is 3%. We are told that currently the inflation rate is going to be 4%. So which basically means that after tax, your nominal, your after tax return requirement is going to be equal to, so it basically means after tax return requirement. So after tax return requirement is going to be equal to a real rate of interest or a real rate of return of 3% plus an expected inflation rate of 4%. So this gives us an after-tax return requirement of what? Of 7%. But now, so from the information that we're given, after-tax return requirement, remember they tell us that if you check on the information that we're given, they tell us that she's prepared to, she's happy with a real rate of return of 3%. And then they tell us that the inflation rate is going to be 4%. So after-tax return requirement is 7% in this case, right? So it basically means that it's your real rate of return plus inflation premium. So which means it's basically your real rate of return plus inflation premium gives you the after-tax return requirement. Then the before-tax return requirement would be equal to, so here before tax return requirement would be given as, so it would be given as the after-tax return requirement divided by 1 minus tax rate. So the before tax return requirement is given as the after tax return requirement divided by 1 minus tax rate. And in this case, it's going to be equal to 7 over 1 minus, remember they say she's taxed at what? At 35%. So 35% is equal to 0.35. So if you say 7 divided by 1 minus 0.35, how much do you get as the after tax return requirement? How much would you get as the after tax return requirement?
I get 10.77.
So you get 10.77. So it will be about what? 10.77%. Now, we also need to find out exactly, so how much should be the return requirement that she needs to be able to get after she reaches retirement. So at retirement, we also need to find out exactly, so how much is the return requirement she needs to be able to generate when she retires as well, right? So what are we told? If we check on the information that we're given, remember the return requirement is given as so the return requirement can also be given as the amount of spending, the spending needs divided by the value of the portfolio at the beginning, isn't it? So the spending needs divided by the value of the portfolio at the beginning would give you this return requirement. So we need to find out exactly, so when she retires, how much is going to be a spending needs, and when she retires as well, how much is going to be the value of the portfolio as well, right? Now, what do we see? Remember we said that for her to maintain a current lifestyle, she's currently earning a salary of what? Of 500,000, isn't it? And remember, when she retires, she's going to be retiring at the age of what? 65, which is what? 7 years from now. And which basically means that her spending needs at retirement are going to be equal to, remember what we know? We know that the future value, so the spending needs at requirement is the future value, right? We know that the future value is given as the present value in brackets 1 plus r to the power of t. So this would tell us exactly the estimation of the spending needs at retirement. So what do we know? We are told on the question, if we check on the question that they gave us, they tell us that the present level of spending and the current annual inflation rate of 4% are expected to continue after her retirement. So her spending needs are basically going to be growing by what? By the inflation rate. And the inflation rate is given as what? As 4%. And currently, the amount of salary that she's earning is enough for her to meet what? Her spending needs as well. So which basically means that her spending needs at retirement is going to be equal to the 500,000 that is currently earning, in brackets 1 plus the growth of the spending needs. Remember, they say the spending needs are going to be growing by what? By inflation rate, isn't it? So the spending needs are going to be growing by inflation rate, which is equals to 0.04 to the power of, remember, she's going to retire at what? In 7 years' time, which is at 65 years of age. So how much is going to be the spending needs, her spending needs at retirement? So how much is going to be your spending needs at retirement?
I get 657, 965, and 0.89.
657.
Yes, 965. 0.89.
0.89. So you can round it off to the nearest cent, or you can even round it off to the nearest dollar. I think the lecturer would find it acceptable as long as you're showing all your working as well. Right? What else do we need? So we know exactly what your spending needs at retirement are. At retirement, this is basically how much she needs to be able to live, isn't it? Now, we also need to find out exactly what is going to be the value of a portfolio at retirement. We are told that she currently has, if you check on the information that we're given as well, they are telling us that she currently has 2 million of savings from prior years held in the form of what? Short-term instruments, isn't it, right? So which means if she currently has an investment of 2 million, we now need to try to estimate exactly what is the value of this investment at what? In 7 years' time. So we need to find out exactly, we also need to find out exactly what is the value of savings, so of a savings at retirement. So we need to find out exactly what is the value of your savings at retirement. And remember, the same thing applies as well. The future value is given as the present value in brackets 1 plus r to the power of what? Of t. This is how you estimate what? The value of an amount in the future. Currently, a savings are worth 2 million. So a savings are worth 2 million in brackets 1 plus. Now, how much is a savings estimated to earn? So we are told, if you check here, the after-tax, remember, now between the use of the after-tax return requirement or the before-tax return requirement, we'll see that the after-tax return of 7% is basically what we're going to be using, mainly because the before-tax return here is not going to be ideal, because anyways, if we earn 10.77% return, what is going to happen after that? The government is still going to tax us, and we go back to what? To 7% after we pay the taxes as well. So which means that we are assuming that this is going to end up earning an after-tax return of 0.07 for how many years? For 7 years, until she retires as well. So if that is the case, how much is going to be the value of your savings at retirement as well?
$3,211,500.
3,211,500. Okay. The other thing that we're also given there, they tell us that Fairfax Incentive Plan participation has resulted in an ownership of Reston stock worth 10 million, which is the current market value. The stock was received tax-free, but is subject to a tax at 35% if sold. So she expects to hold the Reston stock at least until her retirement, isn't it? But remember, at retirement, is she going to take anything out of the out of the stock portfolio? Currently, from the information that we have, at retirement, she's not going to need what? To take anything out of your investment portfolio. So we're going to assume that that amount is going to remain as is as well. And if you please take note as well, your savings is earning interest. That's why we were able to estimate exactly how much the savings are going to be worth at the point of retirement. But the stock portfolio, we don't know what's going to happen to the stock portfolio, mainly because the value of the stock portfolio is going to be determined by the forces of what? Demand and supply. So we are going to estimate that in the best case scenario, the value of the portfolio is going to remain the same at what? At 10 million. So when we're trying to estimate the 10 requirement at retirement there, we are also going to assume that the value of the portfolio is not going to lose value or is not going to be increasing. We are going to assume that is what? the stock portfolio is going to remain the same, although we know that this is a very subjective assumption as well. So it means the value of the stock portfolio, so the value of the stock portfolio at retirement is assumed to be equal to 10 million. So the value of the stock portfolio at retirement is going to be assumed to be equal to 10 million. We're not going to assume a growth rate of 7%, mainly because if it was an investment in an interest generating investment, that's when we can use an estimated interest rate of generated of 7%. But in this case, it's the stock portfolio, and remember the value of the stock portfolio is going to be determined by the forces of demand and supply. So which means the estimated value of the total portfolio at retirement is going to be equal to 10 million plus 3,211,500. And how much is going to be the estimated value of the total portfolio at retirement? So how much would be the estimated value of the portfolio at retirement?
$13,211,500.
So it would be 13,211,500, right? So a return requirement the return requirement at retirement is going to be equal to a spending needs, which is 657,965.89 divided by the value of the portfolio, or which is basically the value of the investable assets of the portfolio. To be more precise, you need to be able to use the investable assets in the portfolio. So this is basically what you're going to be using there. So the value of the portfolio that we're talking about here is the value of the investable assets. Please take note of that as well. So in this case, the value of the investable assets at retirement would be 13,211,500. And then if you multiply that by 100, how much is going to be the return requirement at retirement? So how much would be the return requirement at retirement?
I get 4.98%.
So the return requirement will be about 4.98%. So the return requirement at retirement would be about 4.98%. So the return requirement at retirement would be about 4.98%. Are we on the same page? Are there any questions? Anyone lost? Next.
Rainer, sorry, I have just
Yes.
one question. So this return requirement would be just when her retirement starts, but would this return requirement even increase as her years of retirement go by, or do we assume that the inflation of her spending needs and the growth on her investments are increasing by the same portions, if that makes sense?
So it's an estimated, it's basically a very subjective estimation as well, if you look at it carefully as well. Mainly because if you look at it effectively, we are assuming that the value of the stock portfolio is going to remain at 10 million. In some cases, we know that over time, although stock portfolios fluctuate over time, usually they get a higher return over time as well. So it's basically an estimation, but it's a it's a very the judgment is very close. It should be close to exactly what we would expect over time as well. So if you look at the issue of the spending need, you are saying the spending needs is. Are you saying that the spending need is growing, and the value of the portfolio? What were you saying about the value of the portfolio as well?
No, that's also growing sufficiently. Sorry, to meet their spending needs as her retirement goes on.
Yeah. So the assumption is that the spending needs are going to be growing by inflation, but at the same time, you're also assuming that what the portfolio is also going to be what by growing by a certain rate of return in this case. So which means that for us to be able to meet the return requirement in our portfolio, we need to be having at least an after-tax return of what the portfolio post-retirement should give us an after-tax return of what 4.98% basically.
Okay.
So that way, it would mean she's going to become able to comfortably meet her spending needs and not be needing to draw down on the portfolio as well. Now, when you're also taking this into account as well, please, how they try to complicate the question sometimes is where, if you look at the case of Miss Fairfax, there was no liquidity needs before retirement, even post-retirement. So the question was quite a bit straightforward as well. In some cases that we're going to be looking at, when you look at preparation of the investment policy statement, the lecturer tries to complicate it by having issues where there's liquidity needs either before retirement or post-retirement. Then you now try to estimate what the return requirement at retirement would be as well. So it makes it a bit more complicated, but we're going to be looking at it as well. So, but bear in mind that usually the question is not really this straightforward. There are some things that the lecturer loves to put to actually, which ends up affecting the spending needs at retirement, which also ends up affecting the value of the portfolio at retirement as well. Are there any other questions? Let's look at, remember now we have addressed the return objectives. Let's look at the risk objective, right? Now, remember what I told you about the trick when it comes to addressing the issue of the risk objective. You need to look at the willingness to take risk. You have to look at the ability to take risk. Then after that, you now try to find a halfway estimation to see exactly overall what is the overall risk rating of this particular investor as well. So whenever you're addressing the issue of risk objective there, the main thing that you need to be able to address, there are two things that you always have to look out for: willingness to take risk, ability to take risk. Then you try to estimate halfway through. Now, as a way of cheating this particular system as well, remember, this is very subjective. It's very, very subjective, because in most cases, the exact answer is very difficult to estimate sometimes. So what you usually do is, normally under normal circumstances, the risk rating that you end up overall giving the investor is usually found between moderately conservative to moderate or slightly above moderate. But in most cases, it's going to be found between moderately conservative to moderate. It's difficult to give an investor a risk rating of conservative purely, mainly because for you to end up recommending a conservative type of investment, it basically means that the willingness to take risk should be low. The ability to take risk should also be low. That way, that's when you can ideally recommend a conservative type of portfolio. But in most cases, they usually give you information where the lecturer loves to give questions where you end up having a recommendation where the risk rating ends up falling between moderately conservative to moderate type of risk rating. And remember, it's difficult to give a client a recommendation to say aggressive type of investment as well, mainly because it would mean the investor has to be having a very high willingness to take risk. The investor has to be having a very high ability to take risk as well. And in most cases, it's difficult to end up having that particular recommendation where you put the investor purely in an aggressive portfolio. Because remember, aggressive portfolios, one problem that they have is that they are not that diversified. And under normal circumstances, you want to diversify the investor portfolio. And that way, that's why you see that most of the portfolios fall between moderately conservative to around moderate there. So if you check most of the questions that the lecturer is going to be looking at, if you look at past assignments or past exam papers, In most cases, the overall recommendation is found between those two, mainly because it's difficult to be too conservative, or it's difficult to recommend a pure aggressive type of investment as well. In most cases, it's found in between there, because this is where you usually find more diversified or balanced portfolios. They usually found between moderately conservative to moderate type of risk rating as well. So if you check on the example that we look at here, when we look at Ms. Fairfax, they say Ms. Fairfax has a below average willingness to take risk, as evidenced by a statement that in any given year, she does not want to experience a decline of more than 10% in the value of the investment portfolio. So this desire indicates that her portfolio should have below average risk exposure to minimize its downside volatility. So a below average willingness is also suggested by a general careful and conservative orientation. Remember what we discussed here? So what we discussed here, where they say Fairfax orientation is patient, careful, and conservative in all things. She stated that the annual after-tax return of 3% would become completely acceptable to her if it were achieved in context where the investment portfolio created from her accumulated savings was unlikely to decline by more than 10% in nominal terms in any given 12 months, which means that in any given year of investment as well. So here they say, her overall wealth position, however, suggests an above average ability to take risk. Because of her preference and non-diversified nature of the total portfolio, the average to below average risk tolerance objective is appropriate for the portfolio. So here they say it should be noted that truly meaningful statements about the risk of Mrs. Fairfax's total portfolio are tied to assumptions about the volatility of resident stock and about when and what price the resident stock will be sold. So because of resident's holding constitute 83% of Ms. Fairfax's total portfolio, it will largely determine the large risk she is likely to experience as long as she's holding remains intact. It remains intact. Her holding remains intact as well. So it's mainly because they're saying it's 83%, mainly because remember it's 10 million and the other 2 million in the savings, isn't it? So which basically means that the total investment is 12 million. So the 10 million of the total 12 million makes it 83% of a holding in the employer's stock as well. That's why they say she's basically overexposed to volatility when it comes to the portfolio. But if you look at the risk rating, the overall risk rating that they're giving there, you see that it's always found in the region that I've told you, where the overall risk rating is usually found between moderately conservative to moderate type of risk rating as well overall. So this is very subjective, but try to make sure that whatever overall recommendation that you give there at the end of the day is found within that particular region there. So it's a very subjective type of assessment when you look at a risk objective. Are there any questions regarding the risk objective? All right. So let's now address the constraints. So looking at the constraints, they say, we look at the time horizon, and here they say Ms. Fairfax has a multi-stage time horizon. So remember, when you look at the investor's time horizon, check to see exactly the things that affect the investor's time horizon is when you're determining the investor's time horizon, you need to check to see exactly, first check to see where they are today, where the investor is today, how much time does she have until retirement, and then how much time is available or estimated post-retirement. That's the first step that you need to check. The second step that you need to check is to check to see if there's any liquidity requirements where she will need to take out a substantial amount of money, whether before retirement or past retirement as well, because the liquidity needs there are going to end up affecting her investment time horizons as well. So those are the two things that you need to always make sure that you take note of. So the first step is to find out exactly from where the investor is, how much time do they have until retirement. Then you look at post-retirement. Then the second thing that you need to look out for now is to find out exactly, is there any liquidity needs that they have before retirement or post-retirement? Because that way, this is how you're now able to check to see, is it, because if they say the investor is at retirement, then after retirement, she's just going to need to live on that money and there's no liquidity needs, or she doesn't need to take out money for anything, then it becomes what? A single stage time horizon. But the moment they tell you that the investor is before retire, a couple of years before retirement, then it basically means that the stage now becomes what? Multi-stage, because in this case, it becomes 2-stage, or it can be 3-stage, or depending on exactly how many stages there are. And they are all dependent on liquidity needs at the end of the day as well. So if you check on the question that they give you, there, or on the discussion, they say, the first stage is the intermediate term period, 7 years until her retirement. So the second stage is the relatively long term, representing Miss Fairfax's life expectancy of perhaps 30 years or more. So during the first stage, Miss Fairfax should arrange her financial affairs in a preparation for the balance of the second stage, a retirement period of indefinite length. So of the two horizons, the second horizon is the dominant one, because it is during this period that the assets must fulfill their primary functions of funding expenses in an annuity sense in retirement. So do you see now how you are able to now cut the periods between whether it's a single stage or it's a multi-stage, or to see exactly, so what are the descriptions of the different stages that she's also going to be experiencing as well. Can you move on to liquidity? So under liquidity, they tell us that, so when you look at liquidity, they say, with liquidity defined either as income needs or as cash reserves to meet emergency need, Ms. Fairfax's immediate liquidity requirements is minimal. She has 500,000 of salary available annually. Healthcare costs are not a concern, and she has no planned needs for cash from the portfolio, mainly because she has no debt, she has no dependence, and the salary that she's earning is able to meet what? Living expenditure as well, or expenditure needs. So because of this, there is what? Liquidity needs are considered to be what? Are considered to be minimal. If there's any liquidity needs, they will tell you that they will give you on the case to say, after a certain period of time, she needs to pay for this, or after a given period of time, she needs to pay for that as well. The moment they give you that information, then it basically means that those are the liquidity needs that you're going to be stating under liquidity, under the liquidity constraints there. Looking at taxes, they say Ms. Fairfax taxable income is taxed at 35% rate. So careful tax planning and coordination of tax policy with investment planning is required. So all else equal, investment strategies should seek to maximize after-tax income and defer the realization of taxable gains. So sale of registered stock will have sizable tax consequences because Ms. Fairfax's cost basis is 0. Special planning would be needed for this sale. So Ms. Fairfax may want to consider some form of charitable giving, either during her lifetime or at death. So she has no immediate family and no other potential gift or bequest recipients are known as well. So in this case, there's no gifting that we're discussing, mainly because is not stated as well. So which means that if there was any gifting that was stated there, you now have to take into account the tax implications that she can take advantage of, the tax concessions that she can take advantage of when it comes to gifting. And remember, when it comes to tax issues, don't go in depth in making recommendation to the client. So you need to take into, you just have to just touch the surface to say there are tax issues that she can also be able to take advantage of when it comes to gifting as well. But don't go in depth now to say, because the donations tax for individual per year is a maximum of 100,000. Don't mention that, mainly because it's not discussed in this textbook, mainly because the lecturer has not given us that information as well. So because of this, You just need to hint out that there's tax implications that, or the tax issues that she can also be able to take advantage of when it comes to gifting. If they are telling us that the client needs to be able to donate something, but at the end of the day, don't go too much in depth when it comes to issues of tax, mainly because you are not a tax practitioner, you're just a financial advisor in the case. So because of this, it basically means that you should avoid going too much in depth when it comes to tax recommendations as well. But what you can also be able to indicate here is basically where you can now basically saying that because of the tax implications of your investments, and because your investments, now in most cases, what the lecturer allows to give you when it comes to the issue of taxes as well, is basically where they say they give you a case where the income tax is higher than the capital gains tax. So if they give you such a case, you are now going to make a recommendation when it comes to taxes where you say the investor must consider reinvesting her returns in the portfolio, so that she's able to take advantage of capital gains tax when she eventually disposes of the portfolio. Because if she withdraws, if she invests in assets which are income generating, she's going to be taxed at a higher percentage, which is going to end up depleting the value of her portfolio. So those are some of the issues that you can also be able to take note of, mainly because the information is there. You're not making tax recommendations, but you're basically using the information that is there and analyzing it to actually make recommendations which are practical to the client as well. Can you move on? The next issue, or the next constraint that they discuss here, is laws and regulation. And here they say Ms. Fairfax should be aware of and abide by all laws and regulations relating to an insider status of the restaurant and a holding of restaurant stock. Although no trust instrument is in place, Ms. Fairfax's future investing is handled by an investment advisor. The responsibility associated with the prudent person's rule will come into play, including the responsibility for investing in a diversified portfolio. So which means when it comes to the laws and regulation, the issues that you're going to address here is that overall, over time, because Ms. Fairfax will need to diversify her portfolio. So over time, Ms. Fairfax will need to diversify her portfolio, especially post-retirement, or as she's approaching retirement, so that her portfolio is not subject to a lot of volatility as well. Because remember, if she's over-invested in an employer's security, which is equity experiences a lot of volatility. So those are the issues that you need to be able to take into account. But now, in trying to diversify her portfolio, it would mean that she will now need to sold off or to sell off some or part of the her current holding in the portfolio as well. Now, in doing so, the issue that you have to take into account, or mention in most cases, because in most cases, when it comes to the legal and regulation issues there, what the lecturer loves to ask you or give you as in the case study is a situation where the investor is having securities invested in an employer, right? And the one issue that you have to be addressed there is that the investor has to follow the proper disclosures that are needed to avoid insider trading implications as well. So the issue of insider trading implications is basically one of the issues that you need to be able to address there, especially when it comes to the laws and regulations in most cases. So we know that in most cases, the cases that the lecturer allows to give you is a situation where the portfolio is not diversified, and over time you want the client's portfolio to be diversified. And in most cases, the lecturer will give you a case where the client is over invested in her employer's stock. So when the client now over time needs to diversify her portfolio, especially as she approaches retirement, the issue that you need to make sure that you highlight there is that she has to make sure that she follows the proper regulatory disclosures when it comes to insider trading implications as well. Remember, we're not going too much in detail. We're basically highlighting the issues that the client has to be on the lookout for. Are we on the same page here? Any questions? All right. So on the last constraint is where we look at unique circumstances and or preferences as well. So unique circumstances are those other issues which are not falling under the other constraints as well. So those are the issues which are not necessarily falling under the other constraints, which are basically unique to that particular client, is basically what you're going to be addressing under unique circumstances. So here they say, clearly the value of restaurant stock dominates Ms. Fairfax's portfolio value. So a well-defined exit strategy must be developed for the stock as soon as the practical and appropriate. So if the stock value increases, or at least does not decline from before the holding is liquidated, Ms. Fairfax is Ms. Fairfax's present lifestyle can be sustained after retirement. So a significant and prolonged setback for restaurant industries, however, could have disastrous consequences for the portfolio. So such circumstances would require a dramatic downscaling of Ms. Fairfax's lifestyle, or generation of the alternate sources of income to maintain a current lifestyle. So a worst case scenario might be characterized by a 50% drop in the market value of restaurant stock and subsequent sale of the stock, with proceeds subject to 35% tax. So the net profit from such a sale would be, so here, when they are discussing unique circumstances, you don't necessarily have to be addressing this, mainly because you wouldn't be given such scenarios as well to be able to address them in the exam. In most cases, the lecturer will not give you such scenarios as well. But if it's given, that's when you're now going to be indicating that if the portfolio loses value, how much would it end up being if Ms. Fairfax now decides to get rid of the employer's portfolio as well. So which means in this case, if it loses by 50%, it means that the end value is going to be 10 million times 50%, which is the remaining 50% that is going to be remaining after the loss. More, then after that, the return is also going to be affected by what? By a tax rate of 35%, which means that from the 10 million, which is only going to be left with what? 3,250,000. Then they say, when added with the savings portfolio, Ms. Fairfax's total portfolio would be only 5,250,000. So for this portfolio to generate 658 in income, a 12.5% return would be required. So which means that in this case, they are also trying to demonstrate that if that is the case where the portfolio loses value and she withdraws that money and invests it somewhere else, what is going to happen? It basically means that a return requirement is now going to end up increasing from 4.98% to 12.5% in this case. So that's basically what they're trying to address in this case, where if you decide now to move the portfolio from in trying to diversify the portfolio, but at the end of the day, the portfolio is negatively affected by market movements as well. It basically means that she's going to be having a situation where the return requirement is going to end up increasing. Is going to end up increasing at retirement as well. So are there any questions regarding the issues or the objectives and constraints that needs to be addressed when it comes to preparation of the investment policy statement? Any questions? On page 54, on the paragraph above point number 1 at the bottom, on paragraph above point number 1 at the bottom, they say the process of selecting the most satisfactory from among several potential strategic asset allocations, both in the case of Susan Fairfax and for individual investors generally, consists of the following steps. So please take note of this, because these are potential theory questions. So here they say, step number 1, you need to determine the asset allocation that meets the investor's return requirements. In carrying out this step, the investment advisor should compare expected returns for the different asset allocations on a basis of consistent with the investment policy statement. So which means that in this case, when you're now looking at asset allocation, which is what we're going to be looking at in chapter 5, you are now going to be checking to see exactly what is the return requirement for the investor. And based on the return requirement of the investor, you're now going to be determining exactly what the asset allocation should be. But we're going to be looking at it in detail when we look at the mean variance frontier approach in doing asset allocation as well. Then the second one, they say, eliminate asset allocations that fail to meet quantitative risk objectives or are otherwise inconsistent with the investor's what? Risk tolerance. Then the next one is eliminate asset allocations that fail to satisfy the investor's stated constraints. And the fourth one is evaluate the expected risk-adjusted performance and diversification attributes of the asset allocations that remain after step 1 through to 3 are to select the allocation that is what expected to be the most rewarding for the investor. But in most cases, when it comes to the question of asset allocation, the lecturer loves to ask you a question where you are supposed to be, or you're expected to use what? The mean variance frontier to be able to determine exactly what the ideal asset allocation would be given the return requirement that what you would have done calculation for in your investment policy statement as well. On page 58, which is section 5.2, they look at Monte Carlo simulation in personal retirement planning. So this section, I'm not really going to be dwelling too much on it, mainly because remember the Monte Carlo simulation is basically where you're trying to estimate to see exactly how much is your estimated distributions and how much is your estimated value of the portfolio, so that you're able to see exactly how much your return requirement would be as well. So you're trying to use the Monte Carlo simulations to actually what? Estimate your return requirement, your return requirement in this case at what? At retirement as well. So what you need to bear in mind is that with the Monte Carlo simulation, you input the current data or the historical data into the computer system, and the computer system is the one that is going to give you the output as well. So because of this, it basically means that I wouldn't expect the lecturer to be asking questions regarding the Monte Carlo simulation, mainly because it's a computer-based system that is going to be used to actually make the estimates or to see exactly what the spending rate is going to be and what the value of the portfolio is going to be, so that you're able to see exactly what the return requirement would be at retirement as well. So the estimation of the return requirement is basically is going to be done by the computer system. So in this case, for exam purposes, I wouldn't expect the lecturer to be asking you questions regarding the Monte Carlo simulation. But if you check on page 59, they say the Monte Carlo simulation methodologies, the technology of retirement planning for individuals now rivals that of corporate pension planning. So the Monte Carlo analysis is computer and data intensive. So its availability for personal retirement planning is at affordable costs is a direct result of the availability of inexpensive computing power. So such methodologies are now readily available to individual investors and their investment managers from a variety of vendors. The Monte Carlo simulation is the process by which probability distributions are arrayed to create path-dependent scenarios to predict end-stage results. So the methodology is useful when trying to forecast future results that depend on multiple variables with various degrees of volatility. So its use in projecting retirement wealth is valuable because the prediction of future wealth depends on multiple factors. So each with unique distribution of probable outcomes. So Monte Carlo simulation is generally superior to steady state or deterministic forecasting because it incorporates the consequences of variability across long-term assumptions, and the resulting path dependency effect on the wealth accumulation as well. So they are basically describing the Monte Carlo simulation in detail to say, because with the Monte Carlo simulation, it basically takes into account the different outcomes that can also be resulting from the different factors that can also affect the performance of your investment portfolio over time and your liquidity needs over time as well. So because of this, that's why you see that the Monte Carlo simulation is considered to be superior, mainly because it takes into account scenario planning when it comes to estimation of your and forecasting of your investment needs as well. So when it comes to the actual exam itself, I don't expect much to be asked or anything to be asked when it comes to the Monte Carlo simulation, when it comes to the preparation of the investment policy statement there. Then after this, I don't see anything else that I would say would be highly examinable. So is there any question or any questions when it comes to chapter 2, which looks at managing individual investor portfolio? Any questions? So what I will need to do is I will need to give you a homework, and the homework that I'm going to give you looks at preparation of the investment policy statement of a particular individual. And what I'm going to do is that this particular homework, I'm going to pick it from past assignments, because the lecturer loves to give questions regarding the investment policy statement, and the lecturer, you will love to pick it from what past assignments and alter them a little bit as well, so that you are it's creating a new scenario, but at the end of the day, it's basically based on a particular past assignment or past paper that you would have given previously as well. So I'm going to give you and prepare a homework for you guys to prepare the investment policy statement. So I'm going to look at the homework question that I can also prepare for you guys to look at on the preparation of the what investment policy statement then. Remember what I told you. Chapter 2 looks at preparation of the investment policy statement, and it's a highly examinable concept in the exam. It's a highly examinable concept. Now, after chapter 2, we're going to be looking at chapter 3, which looks at managing institutional investor portfolios. And on this section, know the mechanics of the different portfolios that I'm going to be looking at. But when it comes to the preparation of the investment policy statement itself for institutional investors, I have never seen the lecturer asking questions regarding that. In most cases, the lecturer loves to ask questions regarding individual investor portfolios and the preparation of the investment policy statement. When it comes to chapter 3, it's just the mechanics of it as well. So are there any questions from chapter 2 before we proceed?